Right then, good afternoon everyone. Welcome to another end of week review at the end of another week of trading that we expected to be quite a busy week of trading. A lot of price moves, a lot of chopping around, which is unfortunately not really what materialized. I mean, you can look at the calendar with a raft of central banks out this week. Look at the RBA, look at the Fed, look at the ECB. Rolls into non-farm payrolls then this afternoon. Couple that with a number of PMIs out of the US. You think, and as well as a manufacturing PMI out of China, you would imagine to yourself that you'd get some solid price movements in a couple of different directions, hoping that we break out of recent ranges across some of the major assets and asset classes. But it's not really what's materialized. I mean, coming to not much happening on Monday. It was a bank holiday in a number of countries across Europe on Monday, so not really a lot of price action. A lot of price movement, on Monday. Did have a manufacturing PMI out US, which was slightly negative, but not much volume and liquidity in markets to get that moving too much. But coming to Tuesday, look at the RBA with an unexpected hike out of Australia. 25 basis points. Consensus, as you can see, 3.6, actual 3.85. The reason being is that inflation still remains troublesome within that economy. 7% for the year-over-year figure over the course of Q1, obviously in relation to end of Q1 last year. So it's a quarterly figure in that country, and they've said that remains too high throughout that country. The unemployment rate remains at lowest levels for 50 years, so it still gives them some wiggle room to continue to hike interest rates with inflation up at 7% and remaining sticky as it has done in a number of the other countries around the world. 25 basis points plus, alluding to the fact that they will continue hiking interest rates if needs be. It seems like they may need to in the coming months ahead, so we'll keep an eye on that. But they said they were going on pause. I went on a pause for the last month, pause for 1 month. Now they're back to hiking rates and saying that could continue. Inflation in the Eurozone would suggest that inflation is remaining sticky, and the Eurozone is remaining sticky. In Italy, as you can see, slightly higher on both prints in terms of the year-over-year figures, the preliminary figures. So inflation still remains sticky throughout Europe, remains sticky in the US, remains sticky in Australia, remains sticky in the UK. No matter where you look, inflation is not coming down the way central banks would hope. Brings us into then some labour market figures out of the Eurozone. Didn't really matter too much. Extended 6.6, ticked down to 6.5 a little bit. Didn't really do too much for us in terms of tradable opportunities, which brings us into the Fed. And the Fed hiking interest rates by 25 basis points, which was to be expected. No surprises there in terms of markets, but it did signal that it may be done with its hiking cycle. They removed a statement from the statement, pointing to the need for additional monetary policy firming. So that would suggest that they are looking at pausing interest rates if they remove a statement suggesting they need further monetary policy tightening. It's obviously not a clear-cut answer, but it does allude to a potential pause on the hiking cycle, which would then leave a terminal rate of 5.25%. Now, if inflation continues to remain sticky and even starts to push higher, remains where it is, that would then suggest that maybe another hike or two are on the way, but certainly for now there is potential for no more hikes to come. Maybe the US banking system, the problems within the banking system, they did note that it is somewhat sound and resilient, but tighter credit conditions do pose a threat or do pose a problem to banking conditions and households and businesses. So something to keep an eye on, but certainly more on the dovish side of an interest rate decision when it comes to the Fed. But that is what we're looking at on Wednesday, which didn't really cause too much price movement sort of across the board. It brings us into the ECB on Wednesday, or Thursday, being yesterday. Previous 3.5, further rate hike at 3.75, and a slightly different picture when it comes to the ECB. Now, we were expecting a 25 basis point hike, followed up by two further 25 basis point hikes from the ECB, and they did suggest that there was no signs of the hiking cycle stopping. They were going to continue hiking interest rates. They announced plans to discontinue the reinvestment of cash from maturing bonds purchased under the 3.2 trillion euro asset purchase program from last year, and they're gonna stop reinvesting money. They're going to continue to hike interest rates. They also said that they were going to leave interest rates at a restrictive level until inflation was down near its target range, which they do suggest will be in 2025. So that would be a further 2 years of interest rates where they are or where they are going to end, which is then an overall hawkish central bank, but it's not materialising the chart, but something to keep an eye on going forward in the coming weeks ahead. NFP then today, bring it over to NFP, big beat on consensus, 73,000 jobs added above consensus, which is obviously strong figures when it comes to the non-farm payrolls. Come to the unemployment rate, actual 3.4 versus a consensus of 3.6, so down from 3.5, so extra 70k jobs added. The unemployment rate ticking down by 0.2. If I just get the medium impact numbers on and scroll back down to Friday, you can see across here comes the average hourly earnings, beating expectations, the month over month and the year over year figure beating expectations. Participation rate unchanged, but strong NFP, strong unemployment rate, strong earnings, pretty strong numbers across the board, which has sparked some upside in the US dollar this afternoon and has naturally then sparked some downside in euro dollar this afternoon. But on the reaction to a hawkish ECB yesterday, maybe slightly difficult for me personally to wrap my head around, but S&P doesn't seem to think a strong NFP is too bad, but certainly the dollar index 10-year yield seem to like it. It's not often you see all three of them up on the same day. Market's a little bit disjointed in recent trade. Obviously, we'll keep an eye on it into the close and see what we can find. But a couple of levels to note. Certainly, when we zoom out a little bit onto the higher time frames, you can look at this big head and shoulders on the dollar index. I think that is worth a look in the coming weeks. In the coming weeks ahead, if you've got the Fed, slowing or stopping hiking interest rates if they have reached a terminal rate of 5.25%, you've got the ECB on the other hand suggesting that they are going to continue hiking interest rates and there's no signs of stopping. It's kind of a bit of monetary policy divergence. Couple that with a big higher time frame head and shoulders. We are testing the neckline of it now. That's something that I would definitely keep my eyes on into next week for some tradable opportunities, right? Couple that with this level on the 10-year bond yield, as you can see, not really any buying appetite offer. I say buying appetite offer, but that would be to sell bonds to push these higher. Long bonds, if interest rates have reached a peak in the US, long bonds is not the worst of bets. And it's certainly a pretty strong level, as you can see here. If I just blow the chart up and zoom into it a little bit across here, you can see across there. Change that up, change the colors, we can see it a bit better. We can see there pretty strong support level, right? Obviously a couple of nice bounces, but there's a lack of appetite to move away from that support level. You come back to then the head and shoulders that we were looking at on the dollar index, which then you can see across there, definitely worth keeping an eye on. Not really much of a level on euro dollar, but the trend is higher on euro dollar at the moment. The trend is lower on the dollar index at the moment, albeit it has paused for about a month now at this stage. But with a dovish Fed, with a hawkish ECB, you have to imagine that probably folds at some point unless we get something in to change people's minds in that. The strong NFP kind of gets in the way of it today, but that's certainly a trade that I'm going to keep my eye on as we come in to next week. And then speaking of next week, if we bring up the calendar of next week, again another bank holiday on Monday due to the King's coronation this week. So the UK out of action on Tuesday, but the UK Bank of England interest rate decision, 25 basis points to be expected next week. Now, inflation is still at 10.4% when it comes to the UK, up from 10.1 up to 10.4 in the most recent reading of the CPI print. Now that is likely to come down. The central bank said it is due to come down, but they have said that and it ticked up in the last month. So 10.4% inflation rate in terms of the year over year figures is ridiculous. It is ridiculous still having double digit levels of inflation within the UK economy. So the central bank need to keep their foot on the gas, but they're already up to 4.25%. They've already hiked interest rates by 4%. And inflation's still growing and still above double digits. So what they do to get that under control is a problem for them to sort out. But another 25 basis points is to be expected. But any forward guidance on the continuation of interest rate hikes worth paying attention to next week. You've got inflation out of the US. Now I think this provides a decent trade if you can get inflation to then push lower. In the US, you got the core inflation reading, you got the total rate of inflation, and also the month over month figure. You'll have the month over month figure for the core inflation print as well, core CPI print, if you go onto your medium impact data releases on this particular calendar. But weak numbers across there kind of plays in line with what we were looking at back in the charts and looking at what we were looking at in terms of the central banks. You got a dovish Fed, inflation continues to cool down, hawkish ECB, get your head and shoulders on the dollar index, a good support level that may fold on the 10-year yield. That is a recipe for a good trade long some euro dollars, which should spark a bit of risk on trading as well. So we'll cross that bridge when it comes to it next week. Certainly Wednesday of next week may provide some decent trading opportunities. But anyways, I'm going to wrap it up there then, folks. I'll let you get on with your long weekends. Enjoy a long weekend. Obviously Monday is off, so we'll be back on Tuesday for another week of trading. Thank you.